Right, so we're at 5:02. I'm just going to go through this stage and sort of introduce us, introduce the company, and let everyone of the professionals introduce themselves as well. And then as people can start going, and we should have more people filtering through as we get to the nitty-gritty of the webinar. So just to explain this is a bit about who Melbourne Capital Group are and our licensors. The part that I want to really raise awareness on is the difference between both wealth management and tax advice, which we will be covering in this webinar. Is each circumstance is individual to everybody's personal circumstance. So what we don't want to do is we don't want to go too much into detail on certain subjects and confuse people because it's so sensitive. So what we do encourage is we're going to cover all the bases. If people can ask questions and we can answer those throughout. But if there's anyone that really needs, what we do encourage is for you to have one-to-ones if you do have any complex situations. So we will reach out to you afterwards to have that chat as well. So hopefully we can cover enough of this as possible, but please do speak professional advice. Don't base all your decisions just based on this webinar. This is more for entertainment purposes and just to update you. I hope that's clear. We're starting to see more people filter through now. Right, so I'm going to go straight into our next slide. So a bit about me. My name's Joshua. I'll be your host for this evening. What I'll be doing is I'll introduce both the professionals afterwards. I work for a Melbourne Capital Group. I'm a private wealth specialist, basically business development and helping more on the community engagement side of the company. I am also the president of the Expats Club, which is where a lot of members will know me from, which is one of the biggest expat communities in Malaysia. And I'm also a relocation expat. So anyone that's on here who I've spoken to, in potentially the MM2H Facebook groups or any of those Facebook groups, and are in the process of relocating abroad directly to Malaysia or other parts of Southeast Asia or the world in general, and that is where my expertise lie, and I can help you gain information on that background. What I'm going to do now is I'm going to lead into the next one, which is Jamie, and just let Jamie introduce himself and Melbourne Capital Group as a whole.
Good evening, everyone. So, as Josh said, I'm Jamie. I'm a chartered financial planner. Been here in Malaysia for over 7 years now. Previously came directly from the UK and provide holistic financial planning advice to expatriates and high net worth Malaysians. Just next slide, please, Josh. So, that's a little bit on myself. And so who are we at Melbourne Capital Group? We are an international professional partner firm of the Chartered Insurance Institute, which is one of the regulatory bodies in the UK. And we provide holistic financial planning advice. That's everything from medical and life insurance through to pension savings investments. We can help with international property purchases. We can do fixed income securities. And at the same time, we are definitely not tax advisors, so we outsource a lot of our recommendations, and we work alongside people like Lawrence, who's on the call today, when it comes to tax. We also work with the legal profession, making sure people have wills. But fundamentally, we're very holistic, so we make sure we're kind of A to Z of financial planning. I'll pass over to Lawrence to do a quick intro on himself, his business.
Lawrence, this one's for you.
Hello there, everyone. I'm Lawrence Hodins, and I set up Hodins Global about 7 years ago as a tax agent to expats. I've lived an expat life since the early 90s, actually, and I now I'm in a position where I know a lot of people are considering moving back to the UK. They're at that stage in life where they need to understand what are the consequences. And I wanted to discuss today a very exciting opportunity for you with the new tax regime in place. There's a lot of people leaving the UK because of the changing tax regime, but it's also quite exciting for those. It's a stage in life where they might be contemplating moving back, and we'll talk about that in due course. I'd also like to mention that anything I'm discussed today is cannot be relied upon until agreed in writing. It's every individual case is specific, and we should discuss that separately on a one-to-one basis. Next slide.
Fantastic, thank you, Lawrence. So just looking at UK movement trends as someone that focuses on helping expats relocate abroad, just looking at some figures, if there over 10,800 millionaires left the UK in 2024. That's actually up by 157% from the year before, where it was at 4,200. We've actually, British immigrants, we've seen 79,000 Brits relocate abroad in 2024, and the numbers keep rising. But we're also seeing a percentage of those returning back, which is 58,000 returning. Everyone has their own individual reasons for either moving abroad or moving back, and everybody's in a different position, both on the wealth management side, which we provide, and the tax side, in which Lawrence provides. So this is one of the reasons why we're highlighting and sort of going into, and basically the title of the webinar in general. So the aspects that we're going to be covering in today's webinar is, at first, we're going to have a look at UK tax changes for 2025 to 2026. This is looking into things such as the change in non-dom status, change in FIG regime. Then what we're going to do is we're going to diverse and split each aspect. So we're going to first focus on those choosing to relocate abroad. Then we'll look at those who are returning to the UK. And so we've got a few questions where we've asked the public and sent sort of questions that they've asked in where we can implement those. Then we'll go into Jamie's side on what Melbourne Capital can provide on the cross-border tax efficient structures. And then we're going to go to a Q&A. Like I said, if you want to ask questions on the side, we do already have some from Facebook, from LinkedIn, from the Expat Club community who have asked. But if you want to write those in there, we will try and answer those. And just a reminder that this is a very sensitive and individual subject. So if it does come to the point where you don't understand something, or you've got such a complex situation, we do encourage you to seek professional advice, both on the wealth management and on the tax side. So if you want to speak to me, Jamie, Lawrence, or your respective Melbourne Capital Group advisors who you're already dealing with, please do reach out, or we'll reach out to you after the webinar. So straight in, we're going to go to UK tax changes. The first, we're going to look into the new non-dom tax rules for 2025 and 2026. And it's only right I lead this to Lawrence. Take it away.
Okay, thanks, Josh. Within the past 200 years, there's been a two-tier tax system. There's been a tax system for UK residents, and there's a separate tax system for foreigners moving to the UK. And in the first system, you're taxed on an arising basis on your worldwide income and gains as it arises. However, foreigners, when they arrive in the UK, they were able to apply the remittance basis of taxation due to the fact that they were of non-UK domicile. They were from another country moving into the UK, and with being of non-UK domicile for the past 15 years, they were able to use the remittance basis of taxation, which allowed them to exclude their foreign income and gains from their tax declarations on an annual basis until they'd exceeded 15 years of UK residence, and that's when they lose the opportunity to apply the remittance basis of taxation. This is what's causing a lot of people to leave at the moment. There's a lot of foreign origin multimillionaires in the UK who are losing that advantage with the new tax regime as of the 6th of April 2025. And that's causing a lot of concern. People are thinking the UK economy is doomed because of these people leaving. However, within the next 4 years, we actually have an opportunity for new foreigners to come into the country and possibly benefit the UK economy. One never knows. But with a new tax regime, it's very favourable for people to consider returning to the UK after a long time away from the UK, or even considering moving to the UK for the first time as a foreigner. The categories that are of concern here are you a long-term non-resident? If you've been out of the UK for more than 10 tax years, what's going to happen is you're going to be able to apply the new foreign income and gains tax regime that we're going to discuss in the next slide. If you're a long-term resident in the UK, you've been in the UK for at least 10 out of 20 tax years, then you're going to be liable to inheritance tax. If you become a long-term non-resident of more than 10 years, then it's possible that your worldwide income will not be exposed to inheritance tax, and we're going to discuss that in a further slide. But for the new policies to apply, we need to understand if you're a qualifying new resident. So we need to look at your past to understand if there's been any exposure or any point in time where HMRC could have deemed you to be UK tax resident. So caution is required there. But if you've been non-UK resident for the last 10 consecutive tax years, then you have quite a significant advantage. And people in my stage of life, after so many years overseas, they'll have assets abroad, they'll have investment portfolios abroad. Previously, these people needed to sell those assets before they returned to the UK. They needed to crystallize their investment gains before they returned to the UK. But now, with this new tax regime, we've got a 4-year window for them to work out what's best for them and still be exempt from UK tax under the foreign income and gains regime. And then we not only want to attract people back into the UK who are of UK origin, but we also are going to attract people back into the UK who were formerly non-domiciled. There are foreigners who are remaining in the UK, despite the large numbers of people leaving the UK, but there are foreigners remaining in the UK, and they've still got income and gains that have not been repatriated to the country. The HMRC are now implementing a policy where those gains and that income can be repatriated to the UK at discounted tax rates, which is extremely beneficial to them, and it's an option worthwhile exploring. At the same time, people who were formerly non-domiciled in the UK have left the UK and now want to come back. They might have been out of the UK for the past 10 years, and they were applying the remittance basis when they lived in the UK prior to those 10 years. In that situation, they are going to be able to apply both the temporary repatriation facility and the foreign income and gains, which is a double benefit to them if they come back to the UK and boost the economy in that sense.
Lawrence,
yes, go ahead.
I was going to say, I think one thing that has been that is kind of, there's a lot more clarity now around around domicile versus residency. So the term domicile, whilst it's still used, it's going to it's going to be, there's less ambiguity, should we say, around
Absolutely
whether you're going to be subject to UK inheritance tax in particular. So a lot of what we're talking about is whether you can take advantage of moving back to the UK. But a lot of our clients and a lot of people on the call have actually been outside of the UK for a very long time. And what we're seeing is a fundamental shift of, whereas before it was very hard to remove your domicile so that maybe your worldwide assets were still subject to inheritance tax, under the new legislation, when it's in force, if you have been in the UK for 10 out of the last 20 years, you will pay inheritance tax on your worldwide assets. If you, and you are therefore deemed a long-term resident, if you have not been in the UK for 10 out of the last 20 years, then only your UK-based assets will be subject to inheritance tax. Your worldwide assets may be outside of the scope of inheritance tax. So I think that fundamental shift that we're seeing may actually benefit a lot of our long-term expatriate clients. But I think the clarity comes around using the statutory residency test to determine whether you've been UK resident in a tax year or not.
And the statutory residence test has got a multiple of tests to be applied and ties to be considered, etc. So there's a multitude of scenarios where you can establish non-UK residence. but there's also multiple scenarios where you've already established UK residence, and we need to be very careful here. So that's fundamental to establishing what options are available to you with the new tax regime. In terms of inheritance tax, I was going to say that previously it used to be, have you maintained your domicile of origin, or is the domicile of choice valid? You know, like, let's say you've moved to Malaysia or the UAE and you've been there for the past 30 years. How do you establish or convince HMRC that your domicile of choice is in those countries? It was very difficult if you maintained assets in the UK, if you maintained a lifestyle that was essentially British. It was very difficult. But now HMRC have removed that, and they've said it's going to be residence-based only, and you need to be a non-UK resident for 10 out of the previous 20 tax years. And then there's going to be some tail effect. So if you've been, and we can discuss that in due course, but it's a very exciting opportunity, and it's good that inheritance tax now is residence-based, and therefore the SRT is very important. But domicile of choice, it's no longer should no longer be a concern.
Fantastic. Right. If anyone wants any more information on this, like I said, you're more than welcome to reach out to Jamie or Lawrence, or direct to me, and I'll connect you with who you need to speak to at that point. You will be contacted after the email on how to do that, or contacted by us. That's a problem. So we're going to move next to the foreign income and gains, the FIG regime. Lawrence, I'm going to leave this to you again, just to explain for people that are completely new to this. What is FIG?
Okay, so FIG is a short name for foreign income and gains. People who are moving to the UK and have maintained foreign assets overseas, generating income, or even generating capital gains, they have to be considered as a UK tax resident. And for the next 4 years, they are going to be, if you apply the FIG regime correctly, there are consequences to applying the FIG regime. But if applied correctly, then you have an opportunity to be exempt from your foreign income, be it foreign rental income, your foreign dividends, your capital gains, the sale of property overseas, etc. You can bring that money into the UK and still be exempt from UK tax, which is great for a lot of people in the UAE, where there's no capital gains tax, for instance, or even currently in New Zealand, for instance. I believe it's coming, but at the moment, if you were to realize capital gains in these countries and bring that money to the UK, it could still be exempt from UK tax, which is quite an important advantage for you to relocate or even consider what life is like in the UK and not be overly concerned about the taxation consequences of all these foreign assets. So we haven't actually seen the new format of the tax return itself, but what will happen is we'll have to list all the foreign income and gains that have occurred in one section of the tax return, and then in another section we have to list those foreign income and gains that we want excluded from the UK tax calculation. And HMRC could possibly pursue you for anything that's not listed in the tax return. So it's a procedure where you have to be aware that full disclosure is necessary. So if you've got dividends in Panama, for instance, they have to be included, and they have to be declared to be exempt from UK tax under the FIG regime.
Lawrence,
So
I think where this becomes particularly interesting, or where what I would say, I guess, is where people need to think about things a little bit more, is where are your assets based now? So maybe I've spoken to many people who have even fixed deposits that are still in the UK. Of course, the interest on those fixed deposits is taxable in the UK. Now, if you move those fixed deposits outside of the UK, I don't know, the Isle of Man or Jersey, for example, then not only is that interest not taxable now, but if there's a point when you go back in the future, you can have up to 4 years worth of that interest being not taxable.
It's a good point. So with efficient planning, you should be able to identify whether or not it's not. I mean, there are general anti-avoidance measures in place, and HMRC might view any short-term moves before you relocate back to the UK as general avoidance. There is the possibility that that could happen. But with long-term planning, you might want to take that money out of your ISA pots and put it overseas, etc.
And let's say,
then,
exactly.
yeah.
Let's say if you've been outside of the UK for a number of years already, and you plan to remain outside for a few more years, again, inheritance tax, having UK assets versus non-UK assets. Again, now from one side, it's becoming much less attractive to keep assets in the UK. Of course, in terms of the foreign income and gains regime, it's attractive to go there for a short period of time. And maybe where we see, I guess, what we see from our clients, typically the main reasons people go back. Number one, kids going to study in the UK for university, for example.
Absolutely.
Maybe you want to go back and be close to them for a few years. You can do that and keep your international assets outside of the scope of UK tax. Number two, elderly parents. We see that a lot. So if parents are sick and people need to go back and look after them for a few years and become UK tax resident, apply for the foreign income and gains regime for 4 years. You can stay there, you can look after them and have your taxes, mitigate taxes.
Yeah, that's right. And if you go back and in that 4-year period, let's say you've got some UK pensions, those UK pensions will remain taxable. But if you apply the FIG regime, those UK pensions will be taxable in full. You will lose your annual tax-free allowance, your annual exemption allowance. So that's a small sacrifice to pay, but it does give you a 4-year window of opportunity to look after your kids who are now university students, to look after the elderly parents, and then possibly decide whether or not you want to relocate and continue to be an expat or to just settle in the UK. It's a valuable opportunity. And I think that many people will take advantage of it.
Just to be clear on that point, sorry. So you're saying that in the UK, everybody has a personal allowance of 12,000.
That's right. As a UK resident, you're entitled to an annual tax-free allowance. Yes.
But if you apply the FIG regime, you give up that allowance, and you, in theory, UK tax is due from 0 upwards on UK.
That's right.
Yeah.
Okay. Yeah.
Okay. I know now this. Am I okay to lead into the temporary repatriation facility? Because I believe that's where we're heading. So, so now, not to be confused with the previous, but what is TRF, Florence?
Okay, so TRF really benefits those foreigners who are still in the UK, or those foreigners who I've got many Malaysian clients who've returned to Malaysia after many years in the UK. Doctors, academics, etc. They might want to return to the UK, and they can do so. And still take advantage of the temporary repatriation facility. So any foreign income and gains that they've earned overseas, if they want to bring that into the UK, then for the first 2 tax years, it will be taxed only at 12%. And in the 3rd tax year, it will be taxed at 15%. So this is quite an exciting opportunity for non-doms currently in the country who want to perhaps even pursue a longer term strategy within the UK. They want to remain here for the longer term, but they've got a lot of assets, a lot of foreign income, and a lot of gains, potential gains. They can bring that into the country within the next 3 years at heavily discounted tax rates. So this is quite an exciting opportunity. Also, people who have been foreigners, who have been, those of non-UK domicile, who have been non-resident for the past 10 tax years, they can come back into the country and they can take advantage of the temporary repatriation facility on income and gains that they had accumulated prior to those 10 years. They can bring that into the country too. And at the same time, they can also take advantage of their their FIG regime. So in future, all foreign income and gains will be exempt from zero, will be exempt and will be subject to zero tax. But also any existing foreign income and gains not previously repatriated to the country can be brought in at reduced rates, 12% and 15%. So for the next 4 years, if they've been non-UK resident for the past 10 years, then for the next 4 tax years, that foreign income and gains can be brought into the country and still be exempt from UK tax, subject to all the rules that we discussed within the FIG regime slide. So it's quite an exciting opportunity. There's a lot of doom and gloom about everyone leaving the UK, but there's great opportunity for those entrepreneurial individuals overseas, and we see a lot of them in Malaysia. We see a lot of them in China and Hong Kong. They have various reasons to consider moving to the UK, be it education for their children, etc. Elderly family members, etc. It's quite an exciting opportunity. And the longer they stay here, can they add value to the UK economy? That's what the government is hoping. And as a tax advisor, it's an exciting opportunity. A lot of people with proper planning can take advantage of the opportunities that now lie ahead.
Fantastic. Jamie, do you have anything to add on that one?
No, I think that's pretty much it. I think the key is basically there's a bit more flexibility maybe than there was previously. So previously, anyone going back to the UK, a lot of long-term expats that have to go back for whatever reason may have crystallized and realized gains prior to going back. Now that's not necessarily the case. You don't necessarily have to do it immediately. You have some time. So yeah, it's interesting. I think when we're about to
we talked previously about the SRT, the statutory residence test. Previously, many people were very concerned about whether or not split year treatment could be applied. Normally, HMRC, they will tax you on a tax year basis from 6 April of 1 year to 5 April of the next year. With split year treatment, it would be, you would only be subject to UK tax on your worldwide income from the date of arrival within a split year. There were various conditions in which split year would be valid, and if those conditions were not satisfied, then you would be taxed on a whole year basis. With the FIG regime, split year treatment could possibly be less of a concern. So if you're in the UK, let's say for emergency purposes, you want to be with your child or the student, or your elderly parents need looking after, split year becomes less of a concern because of the FIG regime, because for the whole tax year, your foreign income and gains is exempt. So it's a very exciting period, and I'm respectful of all the doom and gloom out there about how the UK economy is going to lose all these multimillionaires, etc., who are adding significant value to the economy. But will they be replaced? There's an opportunity for them to be replaced, and quite exciting times lie ahead for them. So if you're a long-term non-expat who's been out of the country for 10 years, and you're worried about your assets overseas, and many of them are, they've got multiple properties, they've got multiple rental income, they're used to tax-free living, they can experience life in the UK for the next 4 years and possibly still benefit from tax-free living.
That may help a lot of people, like we said, on the subjects that we touched on, whether that's going back for temporary status on education or the elderly or any of those, or anyone considering all of the new changes that we've just spoke about. We are going to move on from this one, but if there's anything that anybody sort of didn't quite hear or the microphone didn't pick up, please feel free to write that in the webinar chat. Or if anybody wants to delve a little bit further into how each individual one of those new changes can affect them and help them, please feel free to reach out. We will connect you with either Lawrence or Jamie or seek professional advice in general to make sure that you don't get stung with not fully understanding what these mean. So we're going to move to the next one, which is proposed tax changes in the future. Now, Jamie, I'm going to pass this one to you.
Thanks, Josh. Yeah, so on the subject of inheritance tax, and if you have been a long-term non-resident, i.e. outside of the UK for 10 out of the last 20 years, only UK-based assets being subject to inheritance tax, worldwide assets being exempted. So we are seeing a lot of people potentially thinking about selling UK properties and taking assets outside of the UK because of this. One other fundamental change which has been proposed, is not yet in, is that from the 6th of April 2027, UK pensions are no longer going to be exempt from inheritance tax. Now, at least since 2015, if not before, UK pensions have been exempt from inheritance tax. So as a financial planner, a lot of our planning around drawdown strategies, so when people come to retirement, where are you going to start taking your assets from? Basic advice has always been draw down on your assets that are subject to inheritance tax first, leave your pensions until last. That's been kind of the recommendations for the last 10, 15 years or so. Now, from 2027, those pensions, which we've been saying, let's just build up, you can get effectively unlimited amounts into them without being subject to inheritance tax. If that now comes into the scope of inheritance tax, some strategies need to be rethought. So a lot of planning that we've done, it's not a case of ripping it up, but it is a case of reviewing things. So there are also many countries in the world that have double tax agreements in place with the UK. Now, what I mean by that is if you have a double tax agreement in place, let's just take Malaysia and the UK, for example, and you have a UK-based pension, it is possible under the double tax agreement to have that pension taxed in the country of which you are resident. Now, if you're resident in Malaysia, currently, under the current rules, and extended at the moment until 2036, there is no tax on foreign sourced income. Now, under the double tax agreement, you can have your UK pension paid out gross of tax and taxed in Malaysia, even though in Malaysia there is currently no tax on that pension. So whilst it's not in legislation yet, it's almost definitely going to come into legislation, I think, in terms of pensions being under the scope of inheritance tax. I think what we've seen under the new government is that taxes are going up and more things are being taxed. It's unlikely to go the other way. So there are opportunities to take advantage of drawing down on pensions. But for me, it's more about reviewing your strategy. Maybe what was working previously may not work moving forward. One thing to note here is that, again, for long-term non-residents, so if you've been outside for 10 out of the last 20 years, or if you're going to be outside, having as little amount of assets in the UK may make sense, or only up until the nil rate band of £325,000. So I think the key here is, again, review your current position, take some advice. If there are double tax agreements in place, try and take advantage of those. They also may not be available forever. Just one thing to note, and I think Lawrence, you will be able to add here, in order to get in order to apply for the double tax agreement, you have to complete a form, send it to HMRC. They then give you a tax code, which is NT, no tax. How long does that process typically take, Lawrence, in your experience?
Oh, I'm glad you asked, because that's what I wanted to discuss. Yeah, it could take a long time. I've known clients to get it quickly, and I've known clients to take it for a long time. It takes a long time, up to a year. So if you're in that situation, I do recommend early planning. Act quickly rather than delay on
and
it.
I think, again,
excuse me.
The main point here is that maybe it's not going to be available forever. Also,
absolutely,
as you mentioned previously, if you're in the UK, you're not necessarily able to just leave the UK, get a double tax agreement, take your pension out, and move back to the UK. As you said before, that would be anti-avoidance. But again, for people who've been outside for quite some time, or if you
absolutely, it's a good opportunity. Yes,
leaving and staying out, I believe you can assist with being a tax agent on the HMRC
that's right.
side. Here in Malaysia, you need to deal with LDHN, and we have some local tax advisors who can also assist you with that. Again, the key is get planning early and get some planning in place.
And it's very important to note that, as you said, that this policy in Malaysia is available until the end of 2026 at least, because tax rules, tax laws, they change. They're always subject to change. And foreign income in Malaysia will it eventually become taxable? We don't know.
Yeah, that's one thing worth stating, that tax changes are ever changing. It's an ever changing landscape. So as of the 8th of May, which is the start of this webinar, the information we're providing is, to the best of our knowledge, the up-to-date information. But for anyone that will be watching a recording later on, we do seek up-to-date professional advice. And well, we advise anybody to seek up-to-date professional advice anyway, because everything we're doing is just surface level, touching at surface level. All the deeper, complex, individual, circumstantial situations, they do need professional advice, because what one works for one person will not work for another. I can also see some questions start coming through, which is fantastic. We are going to do a Q&A at the end where we will cover those. So please try and put as many of those in as possible, and we will try and cover. I'm going to move on to our next slide, which is relocating abroad and UK assets considerations. Now, every single person you may be in different, the people that are watching this webinar will be in different positions. So some people will still be in their home country considering a move out here. I can see there's some people in here who have been abroad for the last 10 years, some people who have recently relocated in the last 6 months. So you're all at different stages, but we're going to try and get through these. If there's any that, like I said, that are specific to you, please answer the questions. So I'm going to ask the first one, which is a commonly asked question. What happens with my capital gains from my UK assets? Lawrence.
Okay. All right. So it depends what class of assets. It could be investments, it could be property, residential property, commercial property. There's various beneficial options available to you if you sell as a non-resident, but everything is subject to general anti-avoidance and to temporary non-residence rules. So in each individual case, I would like to say that it depends, and I'd like to discuss each particular case in isolation. But it is possible for you to be exempt from capital gains tax on a certain class of assets, but not on property, if you satisfy the general anti-avoidance and the temporary non-residence rules. But on UK property and land or commercial property, there will always be capital gains tax. And how much exposure you have to the capital gains tax over the life of the asset could be reduced as a result of you being non-UK resident. And there are compliance procedures to be addressed and payment procedures to be addressed as well. And these need to be done within a certain time frame. So everything needs to be reported on a real-time basis, and then again at the end of the tax year. I've lost you, Josh. You seem to have frozen.
I think you seem to have frozen. You seem to have frozen on ours. Is everybody frozen? Because I can see Jamie moving and oh, you're back. I can see you. Right, we're in. Well, don't worry, we'll crop that part out of the recording. We've got the technology to do so. When I've got so moving on to the next one, which is probably something that every Brit has asked at some point in their relocation expat life, is when should I notify HMRC when moving abroad?
Okay, so if you're leaving the UK without ever having had any tax reporting obligations through the self-assessment process, whereby you file a tax return at the end of the tax year, the procedure is to just go online and file a P85, and you can submit the P85 online. So you'll get your P45 from your employer. And then you use that data and you submit a P85 with your new overseas address, etc. However, if you are like many individuals with a need to file a tax return annually, then HMRC will be updated whenever they receive your new tax return, because in the new tax return, you have to complete the residence pages section within the tax return, and that will let them know that you've left the UK and how many days have you been in the UK since your date of departure, etc. So HMRC will be notified correctly. Now, this option, a lot of people in the UK might be doing their tax returns via the government gateway, but this option, when you leave the UK, is not available to you via the government gateway. So please get in touch with myself and I'll take you through the process.
Yeah, well, we will show you how to do that at the end, and we will email out if anybody's got that question and are unsure how to do that. The next one we're going to move over, which is What should I do about my voluntary national insurance contributions? Just delving a bit further into those that want to take part in this and are looking for things such as staying in touch with a state pension and so forth. Jamie, I'm going to leave this one to you.
Yeah, perfect. So for those that don't know, in order to qualify for the full UK state pension, you need 35 years of national insurance contributions. In order to qualify for any UK state pension, you need at least 10 years national insurance contributions. Now, if you're in the UK and you're working in the UK via an employer, then automatically national insurance contributions get made. If you're self-employed, you pay them voluntarily. If you move overseas, you are able to continue making voluntary national insurance contributions. There are two different classes. If you are working internationally, you can pay class 2 voluntary national insurance contributions, which are the lower rate. If you are not working overseas, you're still able to make contributions, but you pay a higher rate of national insurance contributions. Now, of course, there's always questions around, should I do it? Should I not? If you're not doing it, you should be making savings. You should be saving things via pensions or other investments. But if you are doing it, then the UK state pension is in payment currently from age 67 and will pay you for the rest of your life. Depending on where you live overseas in the future, it may or may not increase. In Malaysia, for example, it doesn't increase. But if you're getting close to state pension age, it's almost a no-brainer to maximize your contributions. And if you are very far away, then in theory you should still make the contributions. But if you're not making them, you should save money elsewhere.
Can I just say here that the relevant document you should look for is CF83. So you'll find that online, and you file that with HMRC, and they'll get back to you, etc. It's a long process. There's a lot of you send them a check, you make a payment, you might not hear back for a long time, but the CF83 is a good way to start.
Yeah,
and if you want to know what, pardon me, if you want to know what gaps
CF83.
existing, if you want to know what gaps exist in your national insurance contributions, there is an online tool as well, available through HMRC for you to understand how much of a top-up you need to make.
Fantastic.
Also, may I add one more thing? If you're returning to the UK with surplus funds, it might be wise then to speak to HMRC and ask them if you can make a top-up now that you've returned to the UK as well.
Fantastic. If anyone wants any more information on those, it is worth doing for anybody that's considering the state pension, especially if you've worked in the UK at some point. And to the best of my knowledge, I know there wasn't an amount there, but it is quite cost effective just to top up a little bit of money to help with that. Just going on to this, I'm not going to answer the questions now, but William, I can see your question. At the end, it says 3 days ago. Can you just confirm in the question whether that's you returned to the UK in 3 days, just so when I do ask it at the end, I'm asking the right question. So now I'm going to move to the next one, which is, should I still file my taxes if I've not earned in the UK?
Yeah, so if you have no need for further self-assessment, you can ask HMRC to put your UTR number on hold until further notice. Now, there's a procedure. You can go online and do that. But if you have a tax agent who's got the authorization in place to speak to HMRC on your behalf, which is something I do for my clients, I will phone HMRC myself and request cancellation of any previous requests for a tax return. And I'll ask HMRC to put those UTR numbers on hold until they have a need again. If failure to do so could incur penalties, and a lot of people are experiencing £100 penalties for unknowingly not filing a tax return within the deadline. The penalty is £100 within the first 3 months of delay, and then £10 thereafter for the next 90 days. So it's in your interest to do some good housekeeping and close that UTR number, your self-assessment tax identification number, in advance of receiving any such penalties. Sometimes the way to resolve this is to file a blank tax return, and I can help you with that if needed.
Fantastic. Now, I know that moving on to the final question on the relocating abroad side, I'm going to move to what if I own property in the UK. I know that you covered a lot of this in your first capital gains from my UK assets. If you could just briefly go over this quite quickly, as I know that we're a little pressed for time.
Okay, yeah, okay. So property in the UK, if it's generating rental income and you're non-resident, you're deemed to be a non-resident landlord, and you have an obligation to declare the rental income received per tax year, less any acceptable rental costs, and whatever remains will be subject to UK tax at once the tax-free allowance has been considered. Also, if you sell a UK property, you need to file a capital gains tax return within 60 days of selling the property. This needs to be submitted with a CGT return, filed on a real-time basis, and any capital gains tax due within that CGT return needs to be settled within the same time frame. I can help you with that. I help many clients with it. There are various options for capital gains tax to be assessed if you're a non-UK resident, and we'll ensure that you receive the best calculation to keep.
Essentially, if you are in the process of selling a UK property, do seek professional advice, because there's different avenues you can take to make sure that you're doing the right one for your personal circumstance.
Absolutely.
Fantastic. Thank you, Lawrence. Now, what I'm going to do now is we're going to move over to returning to the UK, protective measures. So what do you need to consider when returning? And I know that we've covered a lot of this in the FIG regime and everything like this. So we have covered a lot of this already. But if you just want to go over very briefly what you do need to consider when returning back to the UK for those that are in the process of doing so.
Okay, well, previously I would have advised to crystallize your investments, etc. But all of that is not going to be necessary because you've got this 4-year window, this 4-year time frame to work out what you want to do with your assets overseas, etc. However, while you're non-UK resident, because of the advantages of selling UK property while you're non-UK resident, you might want to consider, are any properties that you hold in the UK part of your long-term planning, or are they superfluous to requirements? If they're superfluous to requirements, if you want to reorganize your property portfolio, then it's a good time to do so while you're non-UK resident, because that opportunity is lost once you return to the UK.
Fantastic.
I think it's an interesting point just to expand on that one. Obviously, from a financial planning perspective, there's quite a few things to consider ahead of going back. What is the cost of living going to be when you go back? How much of an emergency fund do you need? Are you going to be buying property to go back and live in, or are you going to rent? Many people kind of just forget what the cost of living is like. So making sure that you've got assets available to cover kind of short and medium term. And at the same time, as Lawrence said, depending on whether you qualify for the foreign income and gains regime, some people may still need to crystallize gains before going back. Many people may not. The new regime offers a lot more flexibility. But again, if you qualify for the foreign income and gains regime, but you have UK assets, i.e., let's say you have plucking numbers here. Let's say you've got £1 million worth of property in the UK generating £50,000 a year income. If you qualify for the foreign income and gains regime and you can sell those properties, move £1 million outside the UK and generate income outside the UK, in theory, you could have tax benefits from getting the same income net with no tax versus being in the UK with tax. So again, a lot of planning to be done ahead of anyone returning.
The main topic of this again is seek professional advice. In any assets, it's always seek professional advice and don't do it on a whim. So now we're going to move to, we had this question on leaving, but back to Lawrence. When should I notify HMRC upon returning to become an immediate tax resident?
So if you're returning to the UK to for employment purposes, then you're going to be entered into a UK payroll. HMRC are going to be updated whenever you join the payroll, so that should be fine. If you return to the UK as a pensioner, for instance, you're receiving a pension, and I've got some clients who've returned to the UK and their pension is actually in an NT tax code that's not been deducted at source in the UK because they've been resident in another country, then that's when you need to inform HMRC, because your pension provider will continue to give you your pension without any tax deducted, which is going to cause problems. It's going to give you cash flow issues, etc. So you need to inform HMRC and then ask HMRC to notify your pension provider that your tax code is no longer appropriate at NT, and they need to authorize your pension provider to change the tax code, because the pension provider cannot do anything without HMRC authorization, and it's not the pension provider's job to ask HMRC to notify them when a change is necessary. So it's up to you as the taxpayer to keep HMRC informed and to make sure that HMRC are aware of where changes are required.
Okay.
So I recommend speak to me as well if you need help in that regard too.
Yeah, that's going to be the same throughout everything. If you do want any expansions or any of these affect you, please do reach out. We can put you in touch with Lawrence or ourselves and try and get the best advice possible. I'm going to pass this one over to Jamie, which is, what should I do if I'm returning to the UK? What should I do about my offshore assets?
I think, as I said before, the new FIG regime has offered a bit more flexibility. So where previously, maybe depending on what types of assets you have, which we'll come on to in a minute, it may have been recommended to crystallize some gains. Right now, you have a bit more flexibility. So you don't necessarily need to do anything immediately, but obviously you need to have a plan with that. So whether that be taking some assets from the UK, moving them offshore, or whether that be, I guess, realizing some gains overseas, depending on what types of assets you have and how long you've been overseas. I think, again, depends on what the assets are, where are you resident, what's the tax position of you leaving your country of residence. So there's, again, plenty to look at there. But
can I say,
the one thing is flexibility is there now.
Yeah, Jamie, can I say one thing here? You might find a Malaysian wife returning to the UK with her UK husband. Within the next 4 years, God forbid, the UK husband might pass away. The Malaysian wife wants to go back. Is the Malaysian property still there, or has it been sold? You know, you've got that flexibility now. Make sense? You follow what I'm saying?
Yeah.
The Malaysian wife who becomes a widow might choose not to remain in the UK, and therefore, because of that 4-year time frame, those assets have still been held in Malaysia, which will make her relocation back to Malaysia that much simpler.
Fantastic. Right, so we're pretty much being led into the next, so I don't have to go too much further into this. But cross-border tax structures, again, Jamie, I'm gonna pass this to yourself.
So again, as I was saying before, if you've got international investments, be that on sort of flexible investment platforms where previously you may have had to realize gains, there's a bit more, there's opportunity to delay some of that crystallizing of gains. At some point, you may want to make them anyway. There are also, and more we are now seeing offshore bond structures, which are technically insurance structures being used to hold assets, because so while you don't pay any tax under the foreign income and gains regime for 4 years on foreign assets, so if you have a flexible investment platform, you can derive dividends or make capital gains within 4 years. After 4 years, those assets will then become taxable in the UK, just as if they were held in the UK. Now, utilizing an offshore bond, you can continue to get tax efficiency from that structure with what's called gross roll-up. So typically, we would see these structures be used for assets in excess of, say, £100,000 or more, £100,000 or more. But in theory, you can have tax efficiencies for more than 4 years. So just to give a couple of examples, you can take 5%, up to 5% per year of assets from an offshore bond, which is deemed tax deferred return of capital. Therefore, if you put £1 million into an offshore bond and move back to the UK, in theory, you could take £50,000 a year from that structure without creating a tax liability at that point. And you could do that for up to 20 years. Any income and gains derived inside of that structure continues to be exempt from taxes until it's withdrawn. So there are structures that are available which have continued tax efficiency. And again, it might be worth, if you're going to the UK temporarily, be that 4 years, 5 years, 6 years, even up to 10 years, utilizing this structure to get a gross roll-up of income and gains inside the structure without having to create an immediate tax liability in the UK. If you then move overseas again, you may be in a jurisdiction where that income or gains is not taxable again. So it's a way of being able to continue that tax efficiency whilst going back to the UK. And again, some of these structures, it makes more sense to set them up well in advance of going back. For example, any time that you've owned the asset whilst non-resident is exempted from future gains. So even if there is a scenario, let's say you set up an offshore bond now, and in 5 years' time you move back to the UK, and in a further 5 years' time you start to take income which is taxable, 50% of that gain would be non-taxable because you held the asset whilst non-resident. So there's a lot of tax efficiencies available for different structures. And again, this is kind of what we're doing in terms of advising people. You just need to make sure it's cost efficient as well as tax efficient. Don't let the tax tail wag the dog. But if it's cost efficient and makes sense to do it, then yeah, let's look at opportunities. Anything to add there, Lawrence?
Just there's a lot of opportunities out there. Just choose wisely and speak to your chartered financial planner to work out what's the best position for you.
I think that's worth adding. So obviously, when we've spoken about tax, it's always good speaking professional advice. But when you're also looking at cross-border tax structures and private wealth management, Jamie is a chartered financial planner. We're representing Melbourne Capital Group, who are a CII recognised firm. Which is a global recognition, which we're very proud of. So if anybody is wanting to look at cross-border tax structures, we will put it in your way to be able to reach out and speak to us. Or if anybody's speaking directly to Melbourne Capital Group advisor, they're more than welcome to ask those questions and sort of lead into this. Everybody's qualified to be able to touch on this subject. Now, I do thank you for everybody that stayed on so long. We do recognise that tax is not the most it's not the most blockbuster of presentations, but it's all important information and the information we need to make sure we do get correctly. So we do thank you for those that have stayed on. We're now going to move over. Before the start of this, I did put out to both the Expats Club Facebook group and LinkedIn communities whether they could ask some questions. I now have Sarah, who is part of the Expat Club in Malaysia, who asked a question which she wanted to aim towards Lawrence, which was, how would capital gains tax work from sales of shares in a UK corporate sale if you're a resident in another country?
Yeah, again, subject to temporary non-resident rules, general anti-avoidance measures, it could be exempt from capital gains tax if you've been out of the country long enough.
Fantastic. Thank you. Moving on to next, we have Simon, who's come through the relocating to Malaysia. I believe he's moving over here at the moment. He's not fully out of the UK yet. But his question is, if you're no longer a UK tax resident, but you receive a deferred compensation from a former employee in the UK, is this still taxable in the UK?
Yeah, income derived from employment duties performed in the UK will remain taxable in the UK.
Fantastic. Thank you. And the last one from here, we have Tim. This one's from the MM2H Facebook group. When leaving the UK, what does one need to do in regard to HMRC to establish that you're no longer a tax resident in the UK moving forward? I know that you have touched on this already, Lawrence, so you could probably... I know that you can get this one.
Again, if you've not got a record of filing tax returns with HMRC, you've never filed for self-assessment previously, then please go ahead and file a P85 online. Give HMRC your address overseas and the details of your P45. Now, what's good about the P85 is that your P45 will include a salary that does not take into account your full tax-free allowance for the year. If you were to leave the UK midway through the tax year, you're still entitled to a full annual tax-free allowance. So once you file your P85, you might get some tax back. However, the P85 is only possible if you're not already a self-assessment taxpayer. So if you're not filing tax returns, the P85 is the way to go.
Right, fantastic. Now we're going to go to the question and answer part, which we've had throughout. I know that one thing that's going to happen, which generally happens, is there's been quite a lot of information that's been expressed in this whole webinar. So there's probably some people that have had maybe an information overload and can't work out which question it is they want to ask, or can't remember if it's been asked. If that is you, don't worry, we will give you a way to contact us after so you can ask those questions. Feel free to forward them to me or these. We're going to start with the first one, which is Adam, which is, once on the NT tax code, would you be able to reclaim any previously paid income tax in the UK?
Yes, indeed. Yes, we can file amended tax returns if you've been filing tax returns previously. So let's say you get an NT tax code on a pension that's been deducted at source while you've been non-UK resident, then you should be able to get a refund. But that has to be done through correct channels, and I can help with that.
Fantastic. Now moving over to William, who has added on to his question as well. So William's just returned to the UK 3 days ago after 15 plus years working outside of the UK, Ireland, Saudi Arabia, and Oman. To avail of 4 years non-dom status, do I have to apply to register from the date I returned to the UK, which was 3 days ago?
So it all depends on whether or not he's been filing tax returns. If he's been filing tax returns, then HMRC are going to be updated when he files his next tax return for the 25-26 tax year. On the 25-26 tax year, he's going to detail all his foreign income and gains, and whatever's been detailed can be exempted from UK tax under the FIG regime. So we need to understand at the moment, has he previously filed for self-assessment? If he hasn't previously filed for self-assessment, then I recommend that he go online and file an SA1 form to say that he's arrived in the UK from such and such a date, and that he's in receipt of foreign income.
Fantastic. Thanks. Moving on to the next one. I've invested in EIS investments more than 3 years ago, being a UK resident at the time. I've benefited from tax breaks thanks to this. Now I'm a Malaysian resident and will cash out one of these investments this year. Should I declare anything to HMRC? Will it still be tax-free and my past tax breaks would still be valid?
I need to look at this one separately.
I can pick up. Yeah, I can pick up slightly. So the rules under EIS is in order to get the 30% tax relief are, as far as I remember, a 3-year holding period. In terms of cashing it out later this year, hopefully that is possible. Some of these schemes are not the most liquid, should we say, when it comes to that. But provided you have satisfied the requirements to qualify for the tax relief upon the holding period and everything else, I believe it would still be exempt.
I believe so.
And in terms of declaring it HMRC, I'm not certain on that one.
That's where I need to do some research. Every case is different, so in this particular instance, I'd like to research. You could ask the guy to either contact me or to ask his own tax advisor at the moment, because he must have had a tax advisor to introduce him to the prospects of EIS in the first place.
Yeah, no, that's fine. Yeah, so looking on that, the person that asked that's coming up as anonymous. But if you can find a way of, my number will be on the screen afterwards, so will Lawrence's email. If you can make a note of that and reach out and just let it be known, we can work out which person you need to speak to, whether that's Jamie or Lawrence directly, or if you're anonymous because you're not that way inclined, if you have a professional tax advisor, please let them have a look at, because you have a very, very bespoke situation. So please make sure that you get that covered before you make any decisions. And looking at the end of this is do you have entitlement to tax incentivized investing while abroad and non-UK tax resident, i.e. VCT and EIS again?
These are opportunities that require individual scrutiny, so I need to understand the situation. I'm happy to take that question directly.
Yeah, fantastic. And I think just one thing I would also add here is, depending on where you are resident, is whether those vehicles are would be recommended for you or are even available to you. For example, if you're in a country where there is no capital gains tax anyway, do you need to take on risk of investments such as VCT and EIS? So yeah, again, that's a very bespoke one, which we're happy to take offline with.
Fantastic. Right. So thank you for everyone for joining. I would like to say thank you for Lawrence. Your expertise has really, really helped everybody. And thank you to Jamie for joining us as well. If anybody has any questions, like I said, please feel free to reach out. My details are at the bottom there. We will send these out, and Lawrence Hodins' email is directly there. Just to cover one last point just before we go, as we've mentioned throughout, and I can't stress this enough, that tax is such a sensitive subject, both wealth management and tax structures and tax in general. One wrong mistake, and nobody wants to get that dreaded HMRC letter saying you owe or anything like that. So what we advise is for every subject, we will find a way of getting you guys getting in touch with us, or we'll reach out to you to make sure you get professional advice, because nobody wants that letter. If you found this review, if you found this webinar insightful, you can scan this QR here where you can leave us a review on our Trustpilot, and we'll also send a recording out. And like instructed, if anybody needs to speak directly, please feel free. We're happy to speak to anybody. We just need to work out if you need to speak to A, Jamie, or B, Lawrence. If you're not in touch with us at this point, you can speak to your respective Melbourne Capital Group advisors. If not, you can speak directly to me using that contact number. So thanks again, Lawrence. Thank you for your time. Thank you for those that have stayed with us. I do understand that it's taken a while, but yeah, we appreciate you staying on, and everyone have a good evening. Thank you.